Have you been watching silver break to new highs, then Googling it and seeing claims that the market is broken? Well, this video is for you because I'll explain what those headlines really mean and show you a system that's under some serious strain and what you can do about it. This is not a tale of villains or broken markets. It's a practical look at how a century-old network clears demand, why retail coin shelves can look thin when wholesale bars are plentiful, and what to watch as the system rebalances. So let's start with what you can see. Prices. Spot silver in London has been trading above New York futures, a rare condition called backwardation. Now, that word backwardation sounds ominous, but it's simple because the price for metal that you can have now is higher than the price for metal you can have later. It's the market's way of saying, I value immediacy today more than promises for tomorrow. It doesn't accuse anyone of anything. It describes a preference. And remember, this isn't a screen trade like a stock, a bond, or a crypto token. This is physical metal, 1,000-ounce bars that must be assayed, transported, insured, and stored. You can't move them with a click. That friction, the reality of having atoms, not pixels, is part of what makes silver so different from financial assets. Now look at lease rates, the annualized borrowing costs for metal in London. They've surged. If you're short metal and need to borrow some to tide you over, you pay up. When that cost spikes, it tells you a queue has formed at the borrow window. Then there are spreads, the difference between bid and ask in spot silver, which widen far beyond the usual sense. When market makers widen their quotes, they're saying two things. First, it's harder than normal to source metal at a predictable price. And second, if they're going to warehouse the risk while they find it, they need to be paid for the trouble. Wider spreads, like higher lease rates, are prices of stress, not proof of scandal. Now put all that together, backwardation, higher lease costs, wider spreads, and you get a picture that looks less like a crime scene and more like a motorway at rush hour. Everything still works. It's just not working as smoothly as it did at, say, 3 a.m. So why London? Well, for a century, it's been the meeting place where 1,000-ounce good delivery bars move between banks, refiners, and large investors. If you picture 4 big doors labelled refiners, banks, ETFs, and industrial users, all opening into the same hallway of vaults and ledgers. Well, most days bars shuffle between those doors without fuss. Some days everyone wants to use the same one at once. And lately that hallway has been busy. Investor interest has risen, certain funds have been adding metal, and India's demand has flared just as London's available inventory has thinned. It's not a global shortage of silver. There's plenty of silver in the world, but the combination of sustained supply deficits, industrial growth, and investors seeking a hedge against inflation, politics, and currency risk has pushed demand sharply higher. Now that surge is now colliding with the limits of physically moving metal between London and New York. In other words, silver's price is rising because the world has problems, not because the market's plumbing does. The plumbing strain is the consequence of the rally, not its cause. But that strain then feeds back into price because moving real metal through a busy system, it takes time, and time costs money. Now, if you think in terms of 3 simple questions every holder asks, do I have it? Can I move it? And at what price will I part with it? If the first 2 answers are yes, the third is what moves the market. Prices are simply the public side of private negotiations about convenience, risk, and opportunity cost. And because silver is physical, not virtual, those negotiations involve trucks and pallets and customs paperwork. The market is not short of silver. It's short of silver that someone is willing to move now at yesterday's price. And that is why you're seeing headlines about bars being flown from New York to London. It isn't exotic behaviour. It's just textbook arbitrage. Normally, silver travels by ship because it's bulky and not as value dense as gold. But put a big enough premium on speed and suddenly an aeroplane makes sense. Airfreight doesn't signal a broken system. It signals the system doing the maths under new incentives. So is this 1980 or 2011 all over again? No. And yes. No, because the structure of the market and the global economy are very different. But yes, because human nature, the preference for immediacy in moments of stress, well, that's timeless. In 1980 and 2011, silver's rallies exposed pressure points in credit, collateral, and logistics. But today's pressure points rhyme, but the cast of characters is broader because exchange traded products, refiners feeding renewable energy supply chains, and buyers from Mumbai to Minneapolis are all pulling on the same set of levers. But we need to clear up two myths that keep social media busy. The first, retail can't find coins, so silver must be scarce. Not necessarily. Coin tightness often reflects a minting bottleneck, not a shortage of metal. A 1,000-ounce bar is not a 1-ounce coin until a refiner and a mint turn it into one. And those steps take time, capacity, and labor. If demand for coins spike, mints either raise premiums, ration output, or both. There can be plenty of wholesale silver while retail shelves look bare because the manufacturing queue is full, or because sellers are waiting for prices and premiums that make sense to them. The second social media myth is if futures are cheaper than spot, the paper market must be broken. Well, backwardation does not mean broken. It simply means there's a premium on immediacy that futures, which settle later, don't capture. Futures still serve their purpose, transferring price risk forward through time. When spot shouts now, futures whisper later. And sometimes those two voices diverge until logistics catch up. And if you want the short version of all this, there's ample silver in the world, but convincing the current holder to make their silver your silver right now requires a price they like. And then there's India. When a major consumer's demand jumps suddenly, it's as if a new door opens and bars that might have circulated between London, New York, and an ETF are diverted to Mumbai. If that happens at the exact moment that Western investors wake up to silver's breakout, or London's free float thins, lease rates rise, and arbitrageurs start pricing air miles. None of this implies misbehavior. It's just calendars and priorities colliding. For investors watching all this, the useful indicators are really straightforward. The spread between spot and futures. If backwardation stays extreme, the premium on immediacy remains high. If it narrows, logistics are catching up. And lease and lending conditions, if rates ease, tension is resolving. If they spike again, there's still a queue. And ETF flows and reported inventories. If funds keep adding metal while regional premiums persist, that metal has to come from somewhere, and you'll see it moving between vaults. And mint and refinery updates, well, changes in premiums and lead times show where the bottlenecks are. And what about regional price gaps? Those persistent differences between Asia, Europe, and the US point to fragmentation, while convergence means the pipes are refilling. Silver inspires emotion. And that is part of its charm and part of its hazard. The best defense against overheating is understanding the mechanism. Prices shout, plumbing whispers. When the shouting starts, listen for the whisper. And right now, that whisper says the world is pushing hard on silver and the system is groaning under the weight. It's not collapsing, it's just clearing at higher prices. But where does that leave the ordinary saver who is deciding between waiting for the frenzy to pass or joining it? I'm not going to tell you what to do, but we can suggest what you might want to think about. Separate three ideas that social feeds often muddle: price, availability, and form. Price is what two sides agree. Availability is what the holder will release at that price. And form is whether you want a 1,000-ounce bar, a 1-ounce coin, or something in between. In calm conditions, those three blur together. And in hectic conditions, they pull apart. And most confusion and most poor decisions happen in that gap. Markets are like airports. When everything's on time, you don't notice the choreography. But when your flight is delayed, you suddenly see how the gates and the crews and the fuel trucks all interact. And we're in one of those moments. Silver's choreography is visible. The planes are flying bars across oceans. Bids and offers are standing further apart than usual. And right now, the price is higher than the later price. That visibility is a gift because it's showing you how the system flexes and how it heals. The silver market has not broken. It's blinked a bit, as any human system does when a lot of eyes turn on it at once. The lesson is not to panic. It's to have some respect for the plumbing, for the logistics, and for the broader truth that silver's rally begins with the world's problems, not in the market pipes. The pipes are simply showing the pressure. And even if those pipes unclog and flows between London and New York return to normal, Well, the forces that built up the pressure will still be there. The supply deficit doesn't vanish overnight. Industrial demand for solar panels or electric vehicles and data infrastructure does not slow because the vault doors suddenly open more easily. And the search for safety in an age of debt, inflation, currency debasement, de-dollarization does not end because a few planes have landed. Once the plumbing catches up, the new equilibrium will sit higher because the world still needs silver. It still wants protection and it still faces the same imbalances that pushed it here. This rally isn't a squeeze in logistics. It's a repricing of reality. If you want to find out how you can start adding silver to your portfolio, why not click on the link below and book a strategy call today?